In 1907, America ran out of money, not metaphorically, but physically. If you think the Federal Reserve has always existed, subscribe now, because this story proves the system you trust today was built on pure panic. The panic didn't begin with flashing screens or algorithmic trades. It began with whispers, with lines forming outside banks before sunrise, with doors slammed shut while people banged from the outside. For a brief, terrifying moment, the United States discovered something it had never fully confronted before. When confidence dies, money follows. This matters today more than ever, because every modern rescue, every bailout, every emergency facility, every temporary fix traces its DNA back to this forgotten moment. Back to a law almost nobody remembers. A law that quietly saved the country and accidentally gave birth to the Federal Reserve itself. At the dawn of the 20th century, America's financial system was still the Wild West wearing a suit. There was no central bank, no lender of last resort, no master switch to flip when fear spread faster than reason. Thousands of banks operated independently, each printing their own notes, each trusting that panic would never arrive all at once. But panic always arrives all at once. The panic of 1907 didn't start on Wall Street. It started with a failed corner of the copper market, a speculative gamble that collapsed under its own weight. One failure led to another. Trust evaporated. Depositors rushed banks not because they were insolvent, but because they were afraid other people might think they were insolvent. Fear is contagious. And in finance, contagion moves faster than facts. Banks began hoarding cash. Clearinghouses froze. The stock market plunged so violently that trading had to be halted, an unthinkable move at the time. The government had no emergency tools, no playbook, no authority to create liquidity. The Treasury could only watch as the machinery of commerce seized up. In the vacuum stepped a private man with public power, J.P. Morgan. Morgan didn't have a legal mandate. He had credibility. He locked bankers in his library, forced them to open their books, and decided who would live and who would fail. He coordinated rescues not with legislation, but with persuasion and intimidation. America survived the panic not because of a system, but because one man was trusted more than the state. That realization terrified Washington, because a nation cannot depend on a single financier's judgment every time the world shakes. The panic of 1907 ended, but the scar remained. Lawmakers finally admitted what they had long avoided. The United States had built the largest industrial economy on Earth without a mechanism to defend its money supply in a crisis. And the next crisis wouldn't wait for debate. So Congress did something unusual. Instead of building a permanent solution, they passed a temporary one. A stopgap, a financial band-aid designed to hold the system together just long enough to buy time. In 1908, the Aldrich-Vreeland Act was born. It didn't create a central bank. That idea was still politically radioactive. Americans distrusted concentrated financial power, especially when it smelled like Wall Street. Instead, the act allowed banks, under extraordinary circumstances, to issue emergency currency backed not by gold, but by assets. Bonds, commercial paper, things that could be trusted when trust itself was scarce. For the first time, money could be created not because gold had been mined, but because the economy needed to breathe. This was revolutionary and dangerous. The act gave national currency associations the authority to flood the system with liquidity when panic struck, but only temporarily. The money would expire. The system would return to normal. At least, that was the promise. Behind closed doors, however, policymakers understood something deeper. Once a government proves it can create emergency money, it becomes almost impossible to argue it shouldn't. The Aldrich-Vreeland Act was supposed to expire in 6 years. Instead, it became a bridge between chaos and control, between decentralized banking and centralized authority. Then history intervened. In 1914, World War I exploded across Europe. Global trade froze. Gold shipments stopped. Capital fled to safety. Every major economy faced the same question at once. How do you finance survival when the old rules no longer apply? Because of Aldrich-Vreeland, the United States had an answer. Emergency currency was issued. Banks stayed open. Liquidity flowed when the world was starving for it. While European nations suspended gold convertibility in desperation, America remained operational, not because it was stronger, but because it had rehearsed the collapse. This is the part most textbooks skip. The law meant to be temporary worked too well. Once the crisis passed, lawmakers didn't dismantle the mechanism. They expanded it, studied it, refined it. The emergency currency showed that financial stability didn't come from metal alone. It came from coordination, authority, and trust enforced by law. The Aldrich-Vreeland Act didn't just save America from panic. It changed how Americans thought about money itself. Money was no longer just something found. It was something managed. That realization led directly to the secret meetings at Jekyll Island, to the Federal Reserve Act of 1913, to a permanent institution built on lessons learned during a moment of near collapse. But the twist is this: the Federal Reserve wasn't born from confidence. It was born from fear. Fear that without centralized control, private power would always step in. Fear that emergency measures would be needed again and again and again. And that fear was justified. Every modern financial rescue, from the Great Depression to 1971 to 2008, follows the same pattern first established here. Crisis, panic, temporary measure, permanent power. The Aldrich-Vreeland Act was never meant to last, but its logic did. It proved that emergency money could stabilize markets faster than gold ever could. It proved that confidence could be manufactured when trust collapsed. And it proved that once a government intervenes successfully, stepping back becomes politically impossible. The world learned from America. Central banks spread. Lenders of last resort became normal. Emergency facilities became permanent architecture. And crises stopped being exceptions. They became the justification. Today, when central banks expand balance sheets overnight, when liquidity appears with the click of a button, when temporary programs quietly become permanent, you are watching the echo of 1908. The system didn't begin with the Federal Reserve. It began with a law passed in fear, justified by survival, and forgotten because it worked. And that may be the most dangerous legacy of all. Because once a nation learns how to print its way through panic, the temptation to do it again never disappears.